and welcome to Sectors Up Close. I'm Elena Casas. Our focus today is on emerging markets and my guest is Marcelo Carvalho, Head of Global Emerging Markets Research at BNP Paribas. An emerging market investor might be forgiven for being a bit sceptical, given what's happened over the past year. The MSCI Emerging Market Index lost over 10%. Contrast that with the 19% gain in the US S&P 500 over the same time period, and you can see why. Part of the reason for the decline is the hammering Chinese stocks took, partly due to a crackdown by authorities on companies such as Alibaba. This index, like others, is heavily weighted in favour of China. It makes up about 32% of the market as of the end of December. This quickly whittles down, as you can see. The fifth largest country on this index is Brazil, making up just under 4%. There are now the potential for headwinds. The US Federal Reserve is widely expected to soon start hiking interest rates and winding down asset purchases. In 2013, this caused the so-called taper tantrum that hit capital flows into emerging markets. Meanwhile, central banks in emerging markets, with China a notable exception, may need to raise their own rates to tackle domestic inflation, even as they struggle to recover from the aftermath of the pandemic. Well, to help us break this down in some more detail, I'm now joined by Marcelo Carvalho at BNP Paribas. Marcelo, hi. Let's start then by talking about those interest rates. The Fed is expected by many economists to raise rates 3 or 4 times in the course of the year, and a lot of emerging markets will also be forced to put up their own rates. So what could the impact be?
I think the impact for emerging markets could be quite important looking forward this year, which appears to be quite challenging indeed for emerging markets. Historically, when the Fed hikes interest rates, as the saying goes, if the Fed sneezes, emerging markets catch a cold. So it's be quite challenging. 3 things I think we need to watch in the Fed. First, how fast they go. Second, how often, and also how far. How fast, meaning that 25 basis points per meeting is priced in, could be more, could be 50. How often markets expect once every quarter that they hike rates, could be every meeting, so as many as 8 times a year. And how far is going to be important as well, where the rates in the US end up in a couple of years from now.
We also, of course, are talking about countries that have suffered very badly from the coronavirus and in some cases been forced to take on high levels of public debt to finance it. How is that going to play out over the next year?
Listen, I think the pandemic has the short-term and the long-term impact. In the short term, I don't worry too much. I think the latest variant spreads very quickly, but it's also relatively short-lived. However, the longer-term impact is on the fiscal accounts. Many governments around the globe, across emerging markets and advanced economies as well, have increased significantly their spending. And there are few things more permanent than a supposedly temporary increase in spending. So we are left with a funding gap that will need to be addressed in coming years. Either spending has to come down or else taxes will have to go up to make up the wider gap.
Of course, that fiscal response and indeed the coronavirus situation has been very different in different regions. How would you compare Asia to Latin America and indeed to Central Europe as we go into the new year? Which region will recover best?
I think Asia is better placed to recover rather than LATAM and a CEMEA region. And the reason for that is domestic inflation, which is a worse problem in Latin America and CEMEA countries, so much so that many central banks in those regions have been hiking interest rates and will likely continue to do so. In emerging Asia, by contrast, inflation is much less of a concern. Therefore, central banks can still afford to keep interest rates low for a bit longer.
And let's talk about China, which of course makes up a significant chunk of emerging market indexes. As I was saying, there's been a lot of concern in recent months about a domestic slowdown there and especially about the property market. Is that going to spread into other sectors of the economy?
I think in China, one particular concern right now is how they handle the latest variant, Omicron, which spreads very fast, and their COVID-0 approach may well result in a near-term impact for activity. However, it is likely that as things evolve over time, as immunity spreads, we should be able to see faster growth in China down the road, but that's probably a story for later in the year than right now.
Thanks so much for that insight, Marcelo Carvalho, Head of Emerging Markets Research at BNP Paribas. Well, before I go, here are some of the top stories in this sector. China's ailing property sector has stirred Beijing's policymakers into action. The country on Thursday cut key 1- and 5-year loan rates. That followed a surprise move by the People's Bank of China on Monday to reduce its short and medium-term rates. The moves come after data showed fresh signs of economic weakness, including falling activity in the property sector. Well, China Evergrande's offshore bondholders say they're now considering enforcement action against the troubled property developer. An ad hoc group of offshore creditors say they've had no engagement with the firm over its restructuring plans, despite repeated assurances. The world's most indebted property company has managed to meet payments or come to arrangements on onshore bonds, but it has nearly $20 billion in offshore bonds deemed in cross-default last month after it missed payments. The group of offshore bondholders say they've retained a law firm for enforcement actions and urged Evergrande to provide transparency on its financial position. Evergrande declined to comment. And Turkey's central bank has held its policy rate steady at 14%, halting an easing cycle that sparked a currency crisis and sent inflation to a 19-year high. The central bank had indicated last month it would pause its easing cycle, and in today's announcement said it will monitor the impact of previous cuts, while it also expects inflation to ease. Under pressure from President Tayyip Erdogan, the central bank began cutting interest rates, leaving real yields deeply in negative territory and sending inflation to 36%. That sparked a currency crisis that saw the lira lose 44% of its value against the US dollar last year. Some relief came last month in the form of costly state interventions in the currency market and a scheme to protect lira deposits. Well, that's your look at emerging markets. I'm Elena Casas, and this is Reuters.